Liz Ann, it's nice to see you. What do you make of the 3,000-point range we traveled in today, and what does it tell you about what we might do in the days ahead?
Well, this is the nature of the beast. We had almost alternating days last week. We came close to it on Friday with the late hour or last hour rally. It didn't quite bring you back into positive territory. We landed up positive on the week. Obviously, we know what happened yesterday. You know, there is a very common occurrence for Tuesdays to kind of be a turnaround day when you have a weak Monday when you look back in history. But it's also just, I think, the nature of who we're dominating trading right now, how much money is sitting in the hands of quants and algos. And I think it causes some of these intraday swings that arguably goes well beyond what the fundamentals suggest is appropriate. You know, we didn't quite have a 9-to-1 update today. When you're looking for signs of a bottom, you want to see that real sort of powerful thrust off the lows. So bottoms tend to be more processes over time, if this is indeed one. Only December 2018 was really sort of a true V bottom. I'm not sure that's going to be the case this time.
Help our viewers understand that you generally do get big bounces like this after a huge slide like the one we saw. The problem is they often don't last very long, and you may, in fact, go back and retest some of the lowest levels that we've seen.
Well, it's also the case, and I put some data in a report that I updated today that's been a running report that we kind of bring back out every once in a while called Panic is Not a Strategy. And in there, it looks at the 20 single best days in the history or the post-World War II history of the S&P 500, and 15 out of the 20 occurred in bear markets, and the other 5 occurred in bull markets, but right after either a bear market had just ended or you had a pretty big drawdown within the bull market. So it really is just testament to the idea that trying to time around these things, given that some of the biggest up and biggest down days tend to happen in clusters. And I think it reinforces that you really need to be disciplined but not make all or nothing decisions because of how dramatic the market can swing in the short term.
What do we do, though, with news now of potential stimulus of the fiscal side?
Well, we know monetary stimulus is somewhat limited in an instance like this. It's almost never really effective in a supply shock. This is a combination supply and demand shock with no end date yet. You know, when you deal with something like a natural disaster, even maybe a 9/11 type situation or the fall of LTCM, any of those instances, they were sort of time certain. So you could start to assess the damage once it had passed. We're at least in the United States, we're still at the beginning of this. So the hit to the economy, the hit to the earnings is yet unknown. So it does make it quite a bit trickier in this environment. Whether fiscal stimulus can help, again, it's a question of whether the fiscal stimulus ends up being saved by consumers, by investors. And given the constraints of this virus, the likelihood that filters right back into the economy, either consumer spending by consumers or business investment, I think that's questionable. So on the margin, the stimulus helps, but it's not the elixir for what ails us right now.
I've heard suggestions as well as, even as bad as the sell-off has been, that the market isn't even quite pricing in a full-blown recession at this point. How much worse would it have to look for that to be the case?
I think that's right. If you look, and I've done a lot of work on this, if you look at what we often call near bear markets, and there have been a remarkable number of them, 6 or 7, where the S&P drops by 19% or so, doesn't quite make it to bear market territory defined by 20%. 6 out of 7 of those did not have recessions. When you've had recessions, the drop tends to be more in the kind of high 20% range. And you have had bear market drops that were not accompanied by recessions, like was the case in 1987. But of course, that was short-lived. Yes, I think that's accurate, that we haven't yet priced in an economic recession. I think we've priced in a lot of economic weakness. You're certainly seeing that in the bond market, with the 10-year having dropped to sub 0.4% yesterday. And I think the stock market kind of played catch down to that. But I would agree that even if maybe we're pricing in an earnings recession based on what the market's done so far, I don't think yet it's telling you that a recession is coming.
Not to mention the factor of plummeting oil, just yet another thing for all of us to think about. Liz Ann, we'll talk to you soon. I'm sure we will. Thanks so much for being with us tonight.